If you're at all like caught unawares by the huge sell-off on Friday, please go back to last week's video where the entire video was the whole narrative of the profile from the lows here of May 18th, talking about why this buying action was very, very weak. And you can see very clearly in that video I talked about over and over, said there's no other time frame money in the market. That means there's no longer term players to support the market. This was very, very weak rally, and that we should go to target, which is the 50% retracement, which is what I'm going to be looking for in this coming week. Note that I'm using the SPX here as opposed to futures. If you read the Ask the Shadow column, Cynthia E., who's a longtime friend of ShadowTrader, wrote in a nice letter kind of confirming what I was saying last week and that she's thinking the same thing. And I just touched upon a couple of points that she raised in her email, and one of which was the fact that when I'm using Fibonacci retracements for longer term targets, I'm using the cash market and not the futures market. It just seems to be more responsive to the fib numbers, seems to come like right in on exact levels to me, rather than having overshoots and whatnot. In last week's video, which was again talking completely about the weakness in the profile here, I want to show you what's going on now to show you kind of a compare and contrast of what's happening in the profile currently. And I have 3 pictures here to show you, so I'll show you these. This is a snapshot of Thursday, which would be 5/31, and I don't have the profile on this computer, so I can't. All I could do was take snapshots from my desktop, and then I emailed them to myself to show you in the video because I'm on my laptop here on the weekend. But if you remember from last week's video, and you'll see it in the third picture here. As a matter of fact, I should probably just start with that one, right? This was all the action that I discussed last week, and you notice this sort of bunching up, and in all of the action here, there was very little elongation of profile. And just so we're straight here, this is not really elongation. This is like a letter B, and this is not good structure. This is the letter P. This is not good structure. Good structure is more like this, where the prices are more evenly distributed all over the profile, and you see that people are active at all price levels. Last week we talked about value overlapping to equal, which we saw here a lot. We talked about poor lows, which is indicative of short covering. So that means that when there's a rally like that, like this in this here was a market that was too short, so it rallied. You can see the asterisks are where you closed. This is typical of a market that has bad structure, that doesn't have the OTF or other time frame, and that's also mentioned in Cynthia's letter, which I'd like you to read in the Ask the Shadow. When this other time frame, which stands for the longer term players, is not active in the markets, whatever direction the market is going at that time is probably unsustainable. And that goes back to the 3 questions. Remember, what is the market currently doing? What is the market trying to do? How good of a job is the market doing getting there, right? So last week we talked a lot about what is the market doing. I felt that what the market was doing was trying to take weaker handed sellers out of the market. And that's what the profile was telling us last week, that weaker hands who were short were being taken out. They were covering, and that sort of buying is never enough to sustain a long-term rally. It can only sustain a short-term rally, which can turn very ugly very quickly, and that's what we saw this week, right? So moving on to this current week, I snapshotted, let me get this here. I snapshotted 5/31 and 6/1, Thursday and Friday. Notice the difference in the profile compared to the other days that we just saw in the other snapshot, where now you have big elongation to the downside, very little of the value overlapped with the prior day, and the value area is much bigger, much, much bigger. And then going on to the next day, this was Friday, quite a rout, right? You had some liquidation break here at the open, was not a lot of value, although there is a lot of value volume-wise. And then you just see time-wise, we went down on a slow grind all day long. And that tells you that the other time frame is selling pretty steadily, because the way they act is very simply that, they'll sell a little, let the market bounce up a bit, sell some more, let the market bounce, sell some more. They're just hammering it all day long. And that's the type of action we saw on Friday, where the market was essentially, down 30 on the S&P. Long value area as well, and a close very, very, close to the low with an elongated profile. So that's the situation there. My position continues to be bearish in the market until I see this 1250. I talked about the 200 period moving average in my pre-market blog for Friday morning, saying that that would pull prices to it. It did indeed pull prices to it. However, there was no pause there, and that's very, very bearish. That's another thing that's going to that's strengthening to me the action that we're going at least to this 50% retracement, which is the 1247 in the S&P. Usually the 200 period moving average will stop prices. They'll hang out there for a while. In the S&Ps, it doesn't seem like it's doing so that much. Here you see a few days of action. Now, obviously, it can break through in one direction and not stop it immediately. Here it acted as good resistance. Here it broke through, then fell back, so it was resistant. So it's something to keep in mind. The amount of emotion on Friday and the way the profile looks, however, tells me that we're probably not going to pause here. So my outlook here is to move over to this 1247 area in the S&P in the coming week. All right. If you have a bearish outlook and you don't want to spend a lot of money or risk a lot of money, the butterfly spread, especially on the weeklies, can be a very, very powerful tool. I got a lot of emails about the Twitter trade, which was the 1290, 1280, 1270. This is actually one of the first times ever this has happened to me because I don't play for this, where the market actually closed right in the sweet spot, so it was a huge trade. The butterfly was bought for 50 cents on the weeklies back on May 23rd. And those of you that follow me on Twitter, you can see it was here. It was this one, bought 1290, 1280, 1270 for the June 1 expiry. Weekly put butterfly for 50 cents on May 25th, excuse me, right when it was filled. And that ended up getting sold out on Friday. I managed to get out of those for everything, anywhere from $1.80 all the way to $6. And then I left 25 of them on. I had a whole bunch of them, as you can see here. And the ones that were left on actually closed out for $8.04. So think about that. 50 cents risk, and then the closeout was at $8.04. So you're talking, it's a huge, 16 times money at that point with a very, very defined risk. Because remember, the butterfly only has risk of what you put into it. So really, like one big win like this can cover a bunch of them. And don't forget, you can always sell out part of it ahead of time and get your money back. One of the reasons that I was getting rid of them at a much lower level than they close is because, remember, on an intraday basis, I don't know if the market's going to gap fill or bounce, right? This is what the market was doing here at the open. I don't know early on in the day if it's going to be a trending day. If this gap fills, remember, my butterfly is 1290, 1280, 1270, and in the morning of the Friday, it only has a few hours left to expire, right? It's got only up until Friday at 4:15 p.m. It's done, right, when the S&P options close. So you have, so what I like to do is I like to get the risk out of the trade ASAP, get the 50 cents back. So for instance, if you buy it for, say, some small amount, let's say it's 50 cents like this one, try and sell half for $1, put it out there. Now you're risk free and you can kind of let it ride. But anyway, so selling all the way down into the close, which worked out really well. I do tweet these pretty often. Not that often really, but they're just trades that I like to do. A lot of times I'll do broken wing on here, which you can actually put on for a credit, and I'll tweet that out here and whatnot. So that's just something to look for. So that's pretty much it for this week's video. I can't stress enough how the situation here is bearish. I think we are going to target. I am maintaining a bearish outlook. As you can see here, my position is a very short delta. I won't get into exactly what my position is because it's kind of convoluted. But negative delta means essentially that I'm long a lot more puts than I am calls, and I'm looking for a longer move down, and my target is here. So this is what I'm looking for. One thing that will be interesting in the coming week is if this fails, right, at the 1247 and we don't hold, let's say we close a daily bar. We should not close a daily bar through this 1247, or at least not by more than, say, 5 S&P points. Okay, that's what we want to look for in the coming week. If we do, okay, then it's got to be the 61.8, which is all the way down at 1207. So then maybe it's time to just hold shorts longer. But I'm going to be looking at that 1247 in this coming week to be getting out of puts, covering short positions, etc., and then reassessing the situation. And to be honest with you, probably going to be thinking long for a bounce, especially given the fact that the last bounce here with the profile, everything I was saying, right, with the whole narrative, was so weak and really like barely got anywhere. I mean, you couldn't even move, to the backside of the channel or anything. So that's why I'm thinking the next one would put us in a very oversold situation. We'd be too far overextended from the basic moving averages of the 20 and the 50. And I would like to see a little bit, stronger of a bounce up. Maybe we move 1250 to over 1300. I don't know, but I'll be watching that. And how will I know the strength of it? Right? Back to the narrative. And I also want to see areas where I'll feel that sellers are getting short, right, at the wrong time, right? We want to see value establish itself a little bit higher, maybe at the 12, say 57 or whatever. The market goes down to 1247, but value will stay there. That will be indicative of that weak hands got short at the wrong time, because that's what they always do. They hit the button at the wrong time, panic out at the bottom of the market. That's what causes the whoosh down, the liquidation at the bottom, and yet value never migrates down with it. And if you're interested in learning more about the profile, I am really excited to note that coming up in June, on June 18th, James Dalton himself, if you don't know who he is, just Google James Dalton. I've been talking about him for a while. Did a seminar with him in Chicago early in May. It was really a great experience for me. James Dalton is going to be coming on our show live on the Squawk Box. I will be subbing for Brad for Monday, Tuesday, Wednesday. That is June 18th, 19th, and 20th. So you'll have me on the Squawk with you for those 3 days. And on the afternoon of Monday, 1:45 p.m. Eastern, we're going to be doing a call out with James Dalton himself, and he'll spend about an hour with us on the phone, talking about the nuances of the profile, what he's seeing currently, longer term picture, et cetera, et cetera. So it's going to be really exciting. So look forward to that. And that's it. On behalf of myself and the entire ShadowTrader team here in beautiful Philadelphia, Pennsylvania, I wish you good trading and good night.